Tasty Live. And interestingly enough, it's not usually the ECB that's the big mover on the week, but boy, do they have the bigger issue to contend with. The main concern, of course, is still very much the same. We have the difficulty of figuring out how to tailor policy for a very divergent region with economies moving at different speeds, but the problem's certainly larger than those of the Fed, where it seemed like the mission this week was to do no harm and say as little as possible that might rattle markets. So what we're going to do here with the ECB is we're going to break down what it is that's expected from this upcoming policy announcement, why it is expected, what the moving parts are, and why this presents such a significant risk of euro volatility. Let's begin with what is actually expected for the policy announcement here. And you can see, as with the Fed, a rate hike is overwhelmingly priced into the market. 96% chance of an increase here. And as we can see, no meaningful easing to follow, at least in the outlook as it now presents itself. We get to about a 74% chance for a further hike by year end. So you can see in that number hikes / cuts column, you have all but one full rate hike baked in now, 0.955. So that's essentially a 96% chance that at least one 25 basis point increase is coming today. And then come December, that one hike is there. These are comparisons relative to where we are currently. So that hike has not occurred yet based on that number. So that's one hike. And then 0.74 of a second one. In other words, a 74% chance that we will get a further increase at that point for a cumulative 50 basis points this year. Now, much like the Fed, what this means is that it's not the substance of today's actions that will probably move markets. It's the guidance that will shape expectations to follow. So is it right, in fact, that there is a 74% chance for further tightening? Should it be higher? Should it be lower? Is it right that we're not expecting any easing essentially over the course of a year from now? Or could there, in fact, be a conversation about something in that direction sometime next year, say? These are going to be the market moving elements of what we're looking at. Now, this begins to capture the problem that the ECB is facing. You can see here the market's inflation expectations being approximated first by Germany's 10-year break-even. That's, as we've talked about so many times before, the difference between nominal and inflation-adjusted bond yields. When you take that difference, you're left with the inflation adjustment to get from one to the other as residual. So what that gives you is the bond market's own inflation expectation. We also have the five-year euro inflation swap, which is a look at 5-year inflation expectations in the swaps market. Euro denominated, of course. And what we see is that these inflation expectations tend to have led underlying CPI by about 6 months. That's, of course, because markets are inherently forward-looking and because it takes time to collect data. It takes time to collate that data, to release that data, which is why, of course, we typically get numbers with quite a bit of lag as relative to where the period occurred that they're describing. So we're going to get Eurozone inflation data for July sometime in August, say. So not surprising that there is a lag here. And the concern that as of the past several months, there has been a divergence in these expectations and inflation. So we continue to get disinflation. In fact, we've come down from north of 10% now to 5.5% in the most recent June numbers. But inflation expectations are plainly saying the ECB is not going to stick this landing because they're trending in the wrong direction. They're going higher. They're saying we're not going to get to 2% and stick. Now, in fairness, these are longer term inflation expectations. These are not 2-year or 1-year expectations, and they are but a hair above 2%. But the important thing is that they're trending the wrong way. So the direction in price growth expectations is fundamentally not what the ECB would want. That seems to beckon more tightening. But the market clearly doesn't seem to think that the ECB is prepared to tighten the screws here, as it were, or inflation expectations would be going down. If the ECB had a credible position here to say, we are going to fight inflation and we will succeed, well, these inflation expectations would be turning the other way. But plainly, they are not. A big reason why is the dire state of the Eurozone economy. We just got updated PMI numbers earlier this week. Recall that in the logic of PMIs, 50 is the center line. So above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. The picture for the Eurozone, based on these numbers that were just released earlier this week for July, is sobering to say the least. We've recorded now a second consecutive month under 50 on the composite index, which means that the Eurozone economy is shrinking. And not only is it shrinking, but the pace at which it's shrinking accelerated in July after a contraction also in June. Now, that manufacturing has been a pain point here is not really a surprise. It's been in contraction for the better part of a year. The latest number is particularly sobering because manufacturing shrank at the fastest rate in 38 months. That's over 3 years. We likewise have a situation where now services, which had diverged, is playing catch up on the downside. And so while we still have positive growth in services, it is the weakest that we've seen in almost a year. And so again, we're getting to a place here where the economy looks abysmal. And the markets clearly are saying, well, if the Eurozone is in recession, how much rate hike can we really expect out of the ECB here? They are not going to have the kind of consensus. Even if, let's say, the president, Christine Lagarde, feels that we should press on and fight inflation in earnest, she's got to corral a governing council of 6 ECB executive officials, including herself, and then the regional heads of every member state's central bank. That's a 25-member group. And she needs to get consensus on it. Now, a lot of that group is probably wailing right now, looking at this dire growth picture, saying, rate hikes, forget that. We need help. Our economies are withering. And so this presents an understandable challenge for the ECB to both deal with this and deal with this at the same time. Now, just so we're clear that the PMI numbers are not a lark, here is the Citigroup Economic Surprise Index for the Eurozone. It tracks how data in the region has performed relative to baseline forecasts. And we can see that really since the beginning of the year, the story has been of brutal deterioration. So not only are the numbers souring, they're souring relative to what the market thinks they should be. So not only is the economy bad, it's worse than the market thinks it ought to be. So the picture in the Eurozone on the growth side, quite dire indeed, and the market's understandably questioning whether this is something that can allow the ECB to get the job on inflation done in earnest. Now, looking at the makeup of CPI and where inflation is coming from, we can see that the problem is much the same as what we encounter in the US. We've had disinflation, that much is clear. That disinflation has primarily come from the headline number, where things have been moving lower. And that decline has largely come from disinflation on the goods side. So we've seen goods costs reined in because we've managed over the recent years mend supply chains. Shipping costs have come down to pre-pandemic levels. So that's helped. And what we don't see is the kind of response that we'd be looking for from services. On the service side of the equation, inflation still looks like it's trending higher. And indeed, core inflation in the Eurozone, as seen in the dotted line there, is pointedly not turning down. That's inflation excluding volatile items like food, energy, alcohol, and tobacco. And what we're seeing here, then, is much the same as we do for the Fed, a sticky service sector and a goods sector where most of the relief has come from. Worryingly, that trend in the service sector continues despite the woeful state of the economy. Perhaps this catch-up from services downward will begin to work against that, but it has not done so yet. And to make matters worse still, the goods side may be starting to look less rosy. We can see here that Eurozone CPI lags by about 5 months behind the Bloomberg commodity price index. This is a measure essentially of imported inflation. So if global commodity prices go up, say oil, copper, foodstuffs, then of course importing those things becomes more expensive. And in doing that, overall price levels go up. And as we can see here, as we've had the disinflation from the peaks above 10 now down to 5.5, that we can clearly see here has come overwhelmingly from the goods side of the ledger, we can see the influence of commodity prices in spades. It would seem that the reason why goods, at least in part, are driving this so far is lower commodity costs. Well, perhaps we are starting to see that tailwind start to shift the other way. We are on the cusp here, indeed just days away from finishing a second consecutive month of gains for global commodity prices. To the extent that this leads CPI by 5 months, once those gains, especially if they continue, work their way into overall inflation, it could be that goods inflation stops cooperating, even as all of this tightening that we've had so far struggles to really get services inflation in a downward trajectory. It's not even that it hasn't fallen enough at this point. It hasn't fallen. Now, one further element to consider here, as ever with the Eurozone, is sovereign risk. We typically look here at the spread between Italian and German bond yields. This is a remnant of the Eurozone debt crisis that broke out just after the global financial crisis, right around 2010. And has to do with this idea that you have this singular monetary policy for all these countries determining interest rates there. But you don't have a single fiscal policy or even a level of fiscal coordination. In the case of the U.S., you, of course, have that in spades. There's a federal government with fiscal authority over the whole, and then there are individual states with fiscal authority over themselves. So there is a fiscal stabilizer effect where if, for example, there is a recession in Texas and a boom in California or vice versa, then there is a flow of federal dollars outside of those states' individual budgets that offsets that. The boom in California generates more federal tax revenue, which can then flow through the federal government as unemployment benefits and other stimulus in the direction of Texas, where there might be hardship, or vice versa. That kind of a fiscal stabilizing mechanism doesn't exist in Europe. And so what happened when you saw in 2010 or so Southern European debt-strapped countries start to be questioned about their credit worthiness to the extent that the markets thought some of them might default and thereby drop out of the euro, threatening the structural integrity of the entire thing. There was all manner of firefighting effort, but there wasn't a fiscal stabilizer to make it not an issue. And so there had to be lots done ad hoc. Now, a lot of these countries have cleaned up their act to various degrees. Italy largely has not. Italy remains saddled with a giant pile of debt. Its banking sector remains saddled with all kinds of bad paper on its books. And so when there is a rise in interest rates, what you typically start to see is a spread opening up wider in between the yields in Italy, where there is a demand for greater compensation because these higher rates might well be the kindling that ignites that giant pile of debt into a crisis, and Germany, where that isn't the case, where there is strict fiscal discipline and there is not a debt issue. And so you start to see those credit spreads widen, essentially around the idea that Italy, with higher rates, is an ever greater credit risk as relative to Germany, the regional sort of standby and benchmark of fiscal excellence. Now, we've seen through this tightening cycle, if we look from the beginning of 2021 here, as the red line, which is the Bloomberg Eurozone Financial Conditions Index, which just measures the cost of credit and the tightness of the credit market in the Eurozone, we saw there that as it has moved into tightening territory, which is under zero, that's that dashed line there, the credit spread between Italy and Germany has widened. We can see that also since the end of last year, the conditions on the credit side have eased a little bit, perhaps as the market contemplates the dire growth situation and the ECB's inability then to go as hard as they'd like on inflation. And in tandem, that rate between Germany and Italy has narrowed some. The question now, of course, becomes, does the ECB have the luxury to tighten harder? It would seem so, because conditions are not as restrictive as they were even a few months ago, and the spread flagging what would be regional structural integrity risk if Italy looked like it might default, as unlikely as that is. Well, then there might not be a euro. It is the third largest economy in the currency, after all. And so when that spread rises, that sovereign risk tells you the currency bloc is facing an increase in danger and threat to its very survival. That seems to be in remission here. So the concerns that the ECB might have in further tightening, at the very least, don't expect to this aspect of the situation, at least for now. A recession seems to be the main concern still, without this overlay, at this point. Now, the markets seem to have latched on to the idea that the ECB's hands are at least to some extent tied by the dire economic situation. And so what we've seen is the yield curve has shifted accordingly. You can see it's moved lower since the last ECB meeting. It's even flattened a little bit as relative to just a week ago, although very modestly so. And as a result, not surprisingly, the euro has weakened. You can see here that in the period that the curve has shifted, so about a week and change, we have in fact seen a euro that topped right around 113 and rolled over. It seems to have made its way through initial support right above the 110 figure, right around 111 and change, 111.30, say, and then found some interim support right above 110.50. We have here then a sort of situation in flux. We seem to be trying to make a break lower, but we found a bit of support at former resistance. If from here we get a turn back through that support, it's looking like we might be looking at a test underneath 109 to follow. If alternatively we break higher, then the attempted breakdown here will have been aborted, and maybe a test back toward 113 starts looking likely. From the ECB's perspective, then, what they need to do is somehow sell the markets on this idea that they can fight inflation and that they will fight it, and that this is something they will push back on. At the same time, they will need to both sell the governing council itself, where there's surely a contingent saying, "Uncle, this pain is too strong, stop killing the economy," as well as tell the markets that even though the pain is bad, it is manageable. And that's reconciling that need to bring inflation expectations back down with the dire state of growth. The way forward may well be to change rhetoric somewhat. Now, it has been the ECB's policy over the past several meetings to essentially pre-announce rate hikes. So when the ECB met last month, they signaled this rate hike was all but certain already then. So too for the preceding meeting. This has been their way of trying to reconcile this issue, to try to really burnish their mettle as an inflation fighter. Well, they did not have as bad of an economic situation then as we clearly have here now. And so trying to parse this difference between these conflicting forces may look something like a pivot to data dependence in terms of the framing of the guidance, to say, well, we're not going to pre-announce another hike this time, but we are going to be very data dependent. And if things look like we need to do more, then we will. And if things look like we can pause, maybe we'll do that. But that, of course, would in itself be a bearish sort of development for the euro, in that it would amount to a dovish adjustment in what the ECB has been doing the past several meetings. It will have said that we are moving away from a sort of singular, two-dimensional focus on fighting inflation and starting to allow some leeway for, if economic data turns south, we might need to go the other way, or at the very least, we might need to pause for a while. Which may indeed be the catalyst that we need to resume this down move on the euro through support, exposing the way lower. Now, of course, if the ECB maintains its hawkish disposition, even in the face of deepening recession, we may well go the other way. And that is macro money for today. Thank you very much, as ever, for joining me. Macro Money is here Monday through Thursday, right after overtime, a show that I do with Head of Futures and Forex here at tastylive, Chris Vecchio, where we recap the day's events and try to make sense of them. Also look ahead to what's next. I'm also on with Tom and Tony for First Call on Sundays, and on with Chris for Futures Power Hour on Fridays. Outside of these shows, I'm opining on tastylive.com under the News and Insights section. In fact, a preview of this very ECB announcement in short written form is sitting there at the moment, talking about much the same things as we did here, as well as opining on Twitter at eur-usd. Thanks very much for joining, everybody. Good luck out there. See you tomorrow.